To Fang, let's see, with equity split, partners, etc., is syndication still worth the time and effort versus you owning 100% of a few deals? Basically, your thoughts on partial ownership versus full ownership. That's really an insightful question, and that's something that you really do want to consider with every deal. Well, look at it this way, and I'm sure you've heard this before, but a small piece of a big pie is better than 100% of nothing, right? So if you can go buy a 100 unit apartment complex, or a 50 or even a 10, all on your own, and just take it down and you own it, well, that's great, and there's benefits to doing that. You don't have the pressure of the fact that you're responsible for other people's hard-earned money. You can make various upgrades and expenditures just based on whether or not purely whether or not you want to or think it's a good idea, and it's yours. And like you said, you can receive 100% of the profits or the distributions from that, both operating it and selling it. But when it comes to syndication, in many cases, syndication wins out because it lets you scale and diversify in a way that you couldn't if you were just using your own money, right? So with syndication, you can be a part of maybe getting 25% or whatever you've pro forma'd. You can be a part of a large number of of apartments in different geographical locations versus, well, I got this one building in this one town and that's what I own. And so if you can do 1,000 units syndicated and get 15 or 25% of that, that will typically add up more quickly than if you're buying a 10 unit here by yourself or a 20 unit here by yourself, and not syndicating. So to me, ideally would be doing both. Would to maybe get some of your own properties that you can just hold on to for 10, 20, 30 years and build long-term wealth. And then at the same time, syndicate larger deals that builds credibility and cash flow and wealth when you sell it. And because typically investors don't typically investors want their money back within 3, 5, or 10 years. It's a little bit harder to say, hey, I'm going to buy this building, never sell it, so go ahead and invest with me. So syndication has its place for scaling. So that's, to me, both is really the best way to do it. Let's see here. All right. Here we are finally live on YouTube. So thank you for your patience, and please jump in there and ask some more questions. Like YouTube and Facebook, if you hit those like buttons as well. Let's see. All right. Are there any national credit unions that you would recommend for multifamily properties? I candidly have not used credit unions for multifamily acquisitions. However, I have talked and met with other people that have, and I've basically heard nothing but good feedback on credit unions. Now, typically, in order to get a loan with a credit union, you're going to have a pre-existing relationship with them. So if you think you're going to be looking at apartment buildings in Columbus, Ohio, then you may want to find a credit union that's based there and open an account and start a relationship with them there. Of course, find out in advance if they do multifamily loans. Because the same thing typically applies for even small banks. So while I haven't done a credit union, I have done multifamily loans with what was literally at the time a bank that had one branch. That they were that small. They just had one branch, but they liked the market that we were going into, and I said, hey, look, we'll put our operating account there, and they said that's what we want. We want a relationship, and they agreed to do the loan, and that was a property. This was back in 5-6 years ago when things were a little bit tougher, that nobody else wanted to lend on, and these guys were willing to do it because they were local, and we formed a relationship with the bank. And to this day, I still talk to the vice president of that bank, have his cell phone, and they've done several other loans for us. So credit union can have the same type of benefits. I haven't personally done it myself, so I'm not sure if there's, I can't just name off any national ones, and I would say that you might actually be better trying to go with the local one. Let's see. All right. What else do we have here? 30-second apartment elevator pitch to a broker. What's the information to get across? Well, I always find this funny because when we call it an elevator pitch, because every elevator I've ever been in, nobody says anything. So I don't think I've actually truly ever heard an elevator pitch. But if I were going to do one, you know, it basically the key thing to keep in mind is honesty, right? So it depends on where you are in the market. So if I'm at a conference and I bump into a broker and he's like, oh, hey, what do you guys do? And I'll say, oh yeah, we've done about 1,800 units. We focus on the Southeast U.S. We like stuff that's between 100 and 250 units, and generally we're hoping to be below about 25 million per acquisition. Do you do a lot of stuff in that range, or and ask a question to kind of get them talking. So if I was starting out, I bumped into a broker or somebody that was in the industry, then it might be a little bit different. So yeah, you know what? I've got some single family rentals, and I've put together some partners, and we're looking to get a 10 unit just somewhere within 30 minutes of Atlanta, and we've been looking at deals on the MLS and LoopNet, and I've seen some great off market stuff. Do you have any properties that in Atlanta that are kind of in that smaller range? I mean, basically, something like that. And of course, you would have practiced it a few times. So when you're giving it, it's going to sound a little bit better than what I just did. But that's the gist of it. And don't ever, the key is don't ever try to come across as something you're not, right? So if if you don't have any experience, don't try to throw out lingo or jargon that you're not familiar with to sound better. The brokers can see through that from a mile away. I mean, so if you literally haven't done anything, other than maybe educate yourself, do you have that conversation? Say, yeah, you know what? I'm in the process of educating myself. We're getting ready. Our goal is to buy, 5 10 unit properties this year in Atlanta. And I've heard that you have a lot of those type of properties and listings. So I'd love to love to connect with you and see what you have, and hopefully put in some offers and do some deals together this year, something like that. So change it based on your situation and who you are. Just remember, be authentic, and don't pretend to be more than you are. And that's because it's, again, everything in this business boils down to relationships, and you wanna start off with real relationships and authentic relationships and who you really are. So, all right, let's see here. Ross, can you give an example of the conversation you would have with a prospective investor when you are trying to raise money? So, just like a lot of things, everything gets easier once you've been in business for a while. So for me, or once you've done a couple of deals and you're looking to, you've met a new investor, and they, you've been talking about, hey, this is what we do, and we were buying these apartments, and they say, oh, I might be interested in that, or well, do you have any current opportunities? The first thing is yeah, I'd love to love to add you to our investor list so that we can keep you apprised of any opportunities that come up. What are your investing goals? And they might say, well, I want cash flow, I want to be passive, I want to be this or that. And so kind of whenever meeting a new investor, you want to make sure that they're a good fit for what you're doing. So it's just questions like, all right, well, are you ready to invest now? Have you invested in other apartment buildings? Have you invested in other syndications? You're trying to find out if they're passive or active or not. If we had another awesome opportunity today, are you able to fund right now? Where would the money be coming from? Would you have to, do you need to sell something? Do you have it available? So those are some of the questions. And, if you haven't done a deal, then of course it changes a little bit, and the conversation revolves more around, what the apartment space is really good right now, and we're looking at deals in Houston, and we're finding some really awesome looking stuff in the 20 to 40 unit range, and if we this is our plan, we're going to buy it, we're going to do this, we're going to do that. So a conversation with an investor, it's a give and take of not only kind of finding out what they're looking for and what they're hoping to accomplish, because you want to find out if they're a good fit for you, and then also at the end of the day, they are your number one client, right? So you want to make sure that you can provide to them what they are looking for. And so officially what it looks like for us is if and to stay on the happy side of the SEC, you should develop a similar procedure. Is, let's say you meet an investor. It's whether they connect with you online or you meet them come across them at a meetup or something like that. The key is to have documentation of that relationship. Unless you're doing a 506c, which means you can advertise to just accredited investors, you want to make sure you have documentation of that you had a pre-existing relationship. So let's say you meet someone at a meetup, and you're like, you get talking, you're like, yeah, I'm going to be, we're looking for 10 to 40 unit properties. And they're like, oh, if you get one of those, I'd be interested in investing. You say, okay, great. Give me your email address. I'm going to email you just a short questionnaire, and that's going to have on it some of the questions that actually I just went over. The investor fills that out. They send that back to you, and then you put it into a CRM. In the beginning, it can be as simple as an Excel spreadsheet, but it could be Salesforce or even something else more robust, where you put that form in, you make notes that, hey, we talked on this day, we had a conversation, and we have now established a relationship, right? So that investor is now in your database. If it's an email or something like that and you haven't actually talked with them, then what I recommend is have them fill out a form, a quick questionnaire, and then schedule a 10 or 15 minute phone call with them so that you actually have, number one, had a concrete point of establishment of a relationship. And again, you want to get to know each other. You want to be able to answer their questions, make sure they're a good fit for what you're doing. So, all right, let's see here. Shannon, in your opinion, when buying an apartment complex, what is the minimum cap rate you use as a benchmark, especially when looking out of state and it's more difficult to use the BRRRR method? Excellent question. Cap rates are a very tricky thing. And because, for example, if you're looking at a value add property that is maybe got some deferred maintenance and isn't managed very well, the cap rate could be, I've actually purchased negative cap rate deals on some value add stuff. So for me, and when I'm looking at various markets, there truly isn't a minimum going in cap rate. And what I mean by going in cap rate is that's the cap rate when you're buying it, right? What is important is is your exit cap rate, right? And how you figure that out is, one of the questions I'll often ask of brokers is say, hey, if this property that I'm buying was fully stabilized and managed really well, what would its cap rate be in today's market? And the broker might say, well, it's again probably maybe a 5.5 to 6 cap, right? So that's what I would use as my benchmark. And then I'm looking at it saying, okay, well, if I'm buying it, if the broker's saying this should be a 5.5 to 6, and I'm buying it at a 4, that probably means either one, I'm overpaying, or two, there's a lot of value add upside to it. And hopefully it's that latter one, because you don't want to be overpaying. And then, so there really isn't a minimum cap rate. The other thing too is especially if you're syndicating, the key thing is are you hitting the returns that you need to give to your investors? So are you getting your investors the cash on cash they need, whether that's 6%, 8%, 9% a year? What's the internal rate of return that your investors are looking for? Is it 12? Is it 15? Is it 18%? If you can hit those numbers, your going in cap rate, in one sense, doesn't matter, because a cap rate is actually in many cases very subjective, right? And if you'll have, if you take one property and have 3 different people look at it, they'll tell you 3 different cap rates, because some people include some expenses, some people don't include this. Does it factor in, are the taxes adjusted for reassessment or not? It's actually kind of a subjective thing. And so the main thing is just kind of say, the benchmark is, what would this be stabilized and well managed? and then you take that number and you say, well, okay, well, how am I buying compared to that? And then also use that stabilized cap rate as a way to predict your exit cap rate, right? So if today it trades at a 6 and you think cap rates are going to be higher in the future, then maybe for your exit you put 6.5. If you think cap rates are going to be lower in the future, then you might say, well, all right, my exit cap rate's going to be 5.5. So hopefully that helps. Let's see. All right. Oh, got lots of questions here. Thanks, guys, for putting in all the questions. Hopefully, we'll get to as many as we can. And again, please help hit the like and the hearts. We definitely appreciate that. Let's see. We've got. Let's see. Which one do we want to pick here? All right, Michael. I'm in the process of using military benefits to get my basics done in college. Would a BBA in accounting be beneficial towards real estate investing? What would be the best degree to pursue? Well, I pursued a chemical and engineering degree to get into real estate, and that seemed to work out okay. So yeah, a BBA in accounting, it would be beneficial in that you are certainly going to have an easier time jumping into financial statements. You're going to have an easier time understanding the lingo, the accounts, how things are structured. You're gonna be able to probably have easier, better conversations with lenders. You're probably gonna be better at underwriting, right? Getting right from the start. However, I would definitely say any of those degrees are not necessary to get into real estate. For me, like the chemical engineering, there's obviously not a whole lot of chemical engineering in real estate, but the analysis and the Excel and the math and all of that certainly helped in real estate. So would a BBA help in that sense? Definitely. Would it be required? Absolutely not. I've met in this business, I've met a lot of successful people who were former engineers. I've met a lot of successful people who were former CPAs, who've had finance degrees, and I've also met successful guys that barely made it out of high school and started right off the bat and have done amazing. So I'm not necessarily saying, don't get higher education, but don't feel like a degree or a certain degree is a requirement to being successful in real estate. All right, Patrick, what's up? Right back at you. Appreciate that. And hey, he followed his what's up with a question. So he's got $300,000 in cash in a little fund money savings account sitting. That sounds like more than a little fun account. That's a good one. Nice. Well done. What's the first move? Well, what are your goals? So are you looking for just passive income and where you can invest, get a return, and focus on other things? If that's the case, then I would find a couple of good sponsors that you can feel like that you can trust and be comfortable with, and that have a good track record, and that you can invest with. And I would split that 300 up among different sponsors, and even within the sponsors, different properties, right? So if you're working with people whose minimum investment is, let's say, 50,000, you could break that into 6 pieces. Maybe do 2 deals with 3 different sponsors, right? And that gives you that diversifies your risk. It gives you diverse income streams, and as long as you're picking the right sponsors and the right deals, that'll give you good passive income. If you're looking to get into apartments yourself and be active, then find a sponsor or someone who's out finding deals who your $300,000 would be really valuable to them. And you can either partner, do a joint venture, and that might be on a 10 unit, a 15 unit, a 20 unit. Or maybe they've got some money, so you can go a little bit bigger. So if you want passive, your next move is to go find some really good sponsors that you are comfortable investing with. If you want active, it's go find somebody that's doing deals. And if you want to if you want to do it just on your own, then jump into the education, spend a lot of time on BiggerPockets, go to meetups, connect, read all the books you can, and get in that way. So good question. So, all right. So, and then actually along the same line, sorry, Oscar, you missed your question, but you said if you had about $25K to start investing in the multifamilies, what steps would you take to get started? All right. if I had 25,000 and I was going to get started in multifamily, I would, I guess it depends on, going to assume that that 25,000 is not needed for anything else. So number one, I would definitely set aside some for whatever education that I need. So, making sure I get some books, I attend all the webinars I can, and maybe even one of a 2 or 3 day course, because you're not going to go to one of those courses and come out a real estate expert, but as long as you pick the right one, you should get a basic operating knowledge, and more importantly, you're going to meet a bunch of other people who have the same interest that you do in investing in apartments, and you're going to meet other people who can help find deals. You're going to meet other people who have money, and you can find different ways to partner. Again, I'll say it over and over again. This is definitely a relationship business. So if I had 25,000, that's probably not enough to go out and just buy your own multifamily property. Now, again, you could be in a less expensive market, and maybe you could take that 25 and buy a fourplex or a 5 unit or something like that. But if you are really looking to scale or do bigger deals or get into syndication, I would go and find someone to partner with where you can add value, and then use that $25,000 to be able to get the deals done. Because when you get a deal, there's money that comes out of pocket. Even if you're syndicating, you have to pay the lender deposits. You have to have the money for the earnest money deposit and all those kind of things. Now, if you're just looking for passive income and you just want to stick the 25 somewhere and go make another 25 or do something else, then kind of gets back to the previous question, is just find either a partner or a sponsor that you're comfortable with, invest that 25,000 with them, and hopefully earn a really good return. All right, let's see, just a couple more questions here before we run out of time. Jose, what is the best way for a new investor to obtain a $6 million loan to build a 38-unit multifamily on a parcel that is owned free and clear? Best way to do that is partner up. So I am actually looking at something similar myself, and you're going to be looking at a construction loan. Those are typically, from what I understand, they're going to give you about 65% of the total cost. It does help that you have the land free and clear. They will credit that towards your equity, is my understanding. But to increase the chances that you're going to get that loan, you're going to want to partner with a developer that has a long and proven track record, and especially a proven track record in that market. Because the bank is not only going to be underwriting you, they're going to be underwriting your developer, your contractor, and anybody else that you're working with. And if you don't have a net worth that's $6 million, somebody in your group is going to need to have the net worth of at least 6 million or so to be able to get that loan. So you're probably looking at finding a what we call a balance sheet partner, and then finding reputable builders for the market that you're in. So let's see. So best to maintain a $6 million loan. Yeah. So and then when you're talking to those developers who are already operating in that market, you want to ask them, say, hey, what lenders are active here? What lenders have you had good experiences working with? And then reach out to other people who have done development and say, well, other developers, and say, what lender did you use? What bank do you use? Can you introduce me to anybody? I've been doing that very thing in the parcel that we acquired for future development. Every contact that we've had, we've been asking for referrals. Say, hey, if you were going to build on this property, who would you build? Who would you use to build it, to do that? And I got 3 names, so we talked to those 3 people. Who do you use? Who do you have the best luck with at the city in getting rezoning done? Okay, that's who we should use. So there's those kind of questions. All right. Let's see. So I do want to mention, David Green's book, as far as, getting started. He has the long distance real estate investing book. I have read that. It is excellent. It has everything in there that you need. And it is focused on single family, but the same principles apply to multifamily. So no matter, so you can definitely can take that book and read it and apply those principles. It works just as well in multifamily as it does in single family. If someone asked about what kind of programs out there for learning, I can't I haven't actually attended any of them, but I can tell you some that I know of is, Vinny Chopra. I do know him personally, and he's a good guy. I believe Neil Bawa has one. Michael Blanc has one. Jake and Gino. There's a handful of them out there. So what I would do is I would take the names of those groups that I just mentioned, go onto the BiggerPockets forums and ask other people. Say, hey, have you attended this seminar? Was it worth it? What did you get out of it? And get community feedback on that. All right, so I'm going to take one more question here. Again, please punch the heck out of that like button. Give us the hearts, so BiggerPockets let us come keep letting us come back and answer your questions. I definitely enjoy doing this with everybody. And after this, if you want to reach out to me and further the conversation, can be reached. It's just, you can Google either Vantage Point Acquisitions, or the website is just vpacq.com. There's a contact us button on there. And if you fill that little form out, it comes right to my email inbox, and look forward to talking with you more. So, all right, let's see what we got here. Oh, you know what? This is a really good basic question. Alexis, what does syndicating mean? Syndicate, it's basically, a way to look at it is, if you want to go on a cruise, right? You're not going to go spend $2 billion buying the Princess of the Sea, getting on that boat and floating around by yourself for 2 weeks just to go on the cruise. What syndication is somebody, a cruise ship operator, buys the boat and then sells pieces of interest in the boat to people who want to enjoy the benefits of it, right? So a couple thousand people pay, a few $1,000s, get on the boat, and you take 2 weeks and you go on the cruise. And everyone who put in money benefits by getting to enjoy all the benefits of the boat and the amenities and the places that it's going. And the cruise operator, if they do it right, benefits by making some profit on buying that asset and then operating it. And so syndicating is very similar in that you're taking money from smaller amounts of money from a large pool of people, bringing that together and using it to acquire and operate an asset that otherwise you wouldn't be able to do on your own. So syndication, again, is basically just pooling together money. You're creating a security, which is the shares of the LLC that owns that property, and letting everybody share in the benefits. So, all right, well, I appreciate everyone joining in today. It's been a lot of fun. Look forward to doing it again here in a few weeks. Again, please hit the like button, and I look forward to talking to you again soon. Take care.